With global markets on edge following Donald Trump's latest tariff announcement, investors and executives alike are looking for clarity on inflation, interest rates, the peso, and the Philippines' economic trajectory. Joining us now for his unfiltered, unbiased take is a name synonymous with market strategy. Jonathan Ravelas, Senior Advisor at Reyes Tacandong Co, formerly Chief Market Strategist at BDO. With his insights, we hope to cut through the noise and help everyone make better investment decisions. Hi, Jonas. Thanks for joining us this morning.
Good morning, Mikey. Very terrifying day.
Yeah, you said it in a text message to me. You said that everyone is terrified, a play on the word terrified. Okay.
Yes.
So let's start by putting the global risk premium into context. Trump's new, harsher than expected tariff policies are sending fresh shockwaves through global markets. What kind of risk premium does this add to the Philippine economy, and how might it evolve in the coming months?
Well, basically, it adds a moderate risk because we're looking at the secondary effects that will come because of this reciprocal tariffs, and that's inflation and currency volatility. So this will add to our costs. So this is, I think, even earlier you mentioned about the supply chain in the news. Then definitely it will impact us because we're a net importer. So that is something that we need to be able to manage so that we keep the risk premiums at quite mildly at the moment.
How exposed are Philippine industries to this new wave of protectionism? I mean, we're going to be hit in terms of electronics and agriculture. That's top of mind. What are your thoughts on this?
Well, basically, our one of them definitely is electronics, and the other one, of course, in agriculture. Especially if we're importing a lot of our food, then that becomes another problem. And of course, one thing to actually look at it from the negative end is really because we import a lot of items, including raw materials, which could affect the supply chain. But if we're able to, again, look at the brighter side of things, the 17% tariff is not as high compared to the other tariffs that were given in other countries like Vietnam. And with our infrastructure spending, and this could actually be a positive for the Philippines, and maybe attract them to manufacture in the Philippines, and hopefully become very positive for the Philippine economy.
Yeah, there are opportunities amidst the global headwinds and the slower global trade. But I mean, looking at the bigger picture, what is your base case for GDP growth this 2025? All things taken into consideration. Thankfully, it's an election year, so that's going to help bump us up a bit.
Yes. So if because there's an election year, my base case is at 6%. So again, the tailwinds of the election should help drive consumption growth. At the same time, with the slowing inflation that we've seen for the first quarter, we're at 2.2%. So this should help recovery of consumer spending. One thing to note is that we've seen the impact of lower oil prices. So that should be very good for transport and energy for us. So that should at least give us that 6% growth.
Jonas, you mentioned inflation. Interestingly, inflation came in at just 1.8% in March, bringing the first quarter average to 2.2%. 1.8% in March, that's way below target. The BSP Monetary Board is going to be meeting this Thursday, April 10th. Rate cuts. How much of a rate cut are you expecting?
Well, basically, if you recall, in February, the BSP governor highlighted uncertainty that kept the pause, and eventually uncertainty continues to be the name of the game at this point in time. Although with inflation at 1.8% for March, the peso last Friday, 56.82, it appears ripe for at least a quarter basis point cut. Although for the full year, I've been looking at 50 basis points up to 75 basis points if things would change, but I think 50 basis point for the year is likely this year.
Okay. All right. Now on to the peso. We don't have that much time, so let's kind of speed it up. How vulnerable is the peso given the twin pressures of global risk and political local and local interest rates easing?
Oh, well, basically for the peso, we're really vulnerable. It's just that I guess we were able to manage currency volatility well in the first quarter. So, but as the trade war escalates, the tendency for the peso is to move probably between 57 to around 59. And I'm looking at a year end of around 59, 58.90. Hopefully that should stem the tide from remittances.
Now, as for the equities side, despite improving fundamentals, equities remain range bound. The PSE index is down by 5.56% year to date. Is there some upside ahead with the rate cuts, or will caution prevail, Jonas?
Well, basically, if we were to look at fundamentals, you have, infrastructure spending, good earnings. We've seen in 2024, we've seen 75 basis point cut last year. That should already kick in. Probably a 25 to 50 basis point additional this year should help try to bring the index closer to 7,100. But again, have we seen the bottom? That is a question that I think all of us are trying to find out. But sad to say, the risks of 5.8 could be tested.
Okay. All right. Some quick rapid fire questions. We're like tight on time. You've seen many market cycles. If you could think of a song that could capture the mood of the economic cycle or economic position we're in now, what would that song be, Jonas?
It's Anxiety by Doechii.
Okay, all right. As we head into the midterm elections, what is one economic issue that you think candidates should be talking about right now?
Corruption.
All right. And what's more resilient, the Philippine peso or consumer spending?
The peso, the Philippine peso.
All right. Thank you so much, Jonas, for sharing all of your insights with us this morning.
Thank you. Have a great day ahead.